So the second part of the question is asking us, using the basis chosen in A, calculate the overhead absorption rate per batch. We have chosen direct labor hours in the mixing. The overhead in the mixing is 177,444. So divide 177,444 divide by 12,500. For the steering, we divide 84,556 divided by the 10,000, the direct machine hours. To give us in the mixing the OER of 14.20 per labor hour, and in the steering 8.46 per machine hour. But the question is asking us overhead absorption rate per batch. So we have to bring in the batches. We are told number of batches in the mixing 25, and each batch consists of 100 bars. So we need to calculate the labor hour per batch. So in the mixing, the labor hours 12,500, number of batches 2,500. So labor hour per batch would be 12,500 divided by 5 divided by 2,500, which gives us 5. Mixing, we've got machine hours 10,000 divided by the batches 2,500, which gives us 4. These we multiply to the OER that we got earlier on. In the mixing, we had 1420, so 14.20 times 5 will give us $70.98. And in the steering, we had 8.46 times 4, which will give us 33.82. You then add the totals, 7.98 plus 33.82, give us a total of $104.80 per batch of mass bars. 104.80, which brings us to the end of absorption costing, but we still meet it down the line. We'll now move to marginal costing. Once we're done with marginal costing, then we have to reconcile absorption costing to marginal costing. Marginal costing is another method of incorporating costs into a product. However, marginal costs only uses variable costs. It treats the fixed costs as being period costs, which will be incurred regardless of whether the product is produced or not. So it only includes that cost which would be avoided if the unit was not produced or provided. Same like absorption costing, will collect the costs on a cost card, but in marginal costing, we'll get the total of the direct material cost plus the direct labor plus the variable overheads. The total of this will give us what's known as marginal cost. It's this marginal costs total which will be used to value inventory. Okay? And absorption costing is the full production cost per unit, which includes the fixed overhead. That's one which is used to value inventory. So you can tell just from this that when you're valuing inventory under marginal costing, the value of that inventory will be different from the value if it's being valued under absorption costing. When preparing profit or loss under marginal costing, the sales minus the variable costs give us what is known as contribution. So contribution is only found in marginal costing. You will not find it in absorption costing. From the contribution, that's when you take out your fixed costs to give you your net profit. So be able to distinguish the calculation of profit using marginal costing from absorption costing. It's very important that you distinguish these two, because it's on that basis that we have to reconcile the differences in this profit. We will illustrate in this question. Good Times Limited manufactures cheap watches which it sells to wholesalers for $25. You are given a cost card there for each watch. You've got the direct materials, direct wages, variable overheads. You are told also that there are variable selling costs per unit of 50 cents. Then you're given additional information for year 1 and year 2. You've been told that there were no opening inventories. All variable costs were as per budget for the 2 years. You are required to set a profit and loss account under marginal costing for both years 1 and 2. So how do we calculate this profit? We have our selling price. The selling price. The selling price is $25. How many watches were actually sold. Actual sales, you've got 13,000 units. So 25 times 13,000 units were the actual sold watches sold in year 1. There was no opening inventory, so the opening inventory will be nil. Then we go to the production. How many units did we actually produce? We produced 14,000 watches at a variable production cost of how much? 20. Which includes the material, the wages, and the variable production overheads. Note that the fixed overhead cost per unit is not included because we're using marginal costing. Then, since we produced 14,000 units, but we sold 13,000 units, we now have closing inventory of 1,000. 14 minus 13 gives us closing inventory of 1,000 units. The 1,000 units, which will be valued at the marginal cost of 20. So the closing units, the value of closing units, 20,000 will be subtracted from the total production cost of 280 to give us the cost of sales of 260. We subtract the cost of sales of 260 from the 325 to give us 65,000, but we have variable selling expenses of 50 cents. We sold 13,000 units, so 13,000 times 50 cents gives us 65. That was a variable selling costs. We subtract and get our contribution of 58,500. Again, remember, contribution is only found in marginal costing. After the contribution, that's when you bring your fixed costs. Your fixed costs, which are made up of overheads and fixed selling costs, 11,000 and 5,000 respectively. When you subtract that from your contribution, you get your net profit of 42,500. We move to year 2. We had closing inventory in year 1 of 1,000, valued at 20,000. So in year 2, we will have opening inventory of 20,000. But how many units did we sell in year 2? We sold 12,500 units. So 12,500 units times 25 gives us 312,500. How much did we produce? We produced 11,500. So the production plus the closing inventory. So So our total production, 11,000 at the marginal cost of 20 gives us 230 plus the opening inventory. That gives us the 12,500 units that we sold. So we did not have any closing inventory now. So there's no closing inventory, so the 250 becomes our cost of sales, which we subtract from our sales revenue. Then we bring our variable selling costs, 205 times 50 cents, 6,250, to give us a contribution of 56,250. We take out our fixed costs, which remains the same, 11 and 5 respectively for production and selling, to give us net profit of 40,250. That's how marginal costing computations are done. The key to remember is contribution. How do you calculate contribution? Contribution is selling price minus the variable production cost minus the variable non-production cost. We have another question there, which I would like you to attempt. Before we go to the advantages and disadvantages.